Smart investing, 3 warning signs before catching the market bottom. Have you heard people whispering, "This is the opportunity"? Stocks are dropping hard. If not now, then when will you get rich? But hold on a second. Do you know that throughout financial history, technical rebounds have deceived millions of retail investors only to be followed by sharp crashes that wipe them out? Thought-provoking questions. Pushpin: why do fake technical bounces often appear right before a deeper market crash? Pushpin: can you tell the difference between a real bottom and just a bull trap? One of the most crucial signs smart investors watch for: has big money truly returned to the market? You might see a few bullish sessions, or small cap and penny stocks hitting limit ups. But don't be fooled by these surface signals. They're often just short-term speculative waves driven by retail investors, not sustainable institutional buying. When real money returns, from funds, institutions, and foreign investors, you'll notice a broad, powerful surge, not just a few tickers rising, but entire sectors gaining with strong liquidity. Are you seeing money flow across key sectors? Or is it just a speculative flash in a few hot stocks? If institutional money is still staying out, are you really ready to jump in? Markets only form real bottoms when investors feel hopeless, discouraged, and ready to give up. On the other hand, if everyone around you is still excited, joining bottom-catching groups, averaging down, saying this is the chance of a lifetime, be cautious. If the crowd isn't in enough pain, the market isn't at a true bottom. Excessive optimism too early is dangerous. Confidence based on hope, not data, is a setup for disappointment. And hope is not an investment strategy. Are your decisions driven by analysis or by emotion and crowd behavior? If everyone believes it's time to buy the dip, maybe it's time to stay patient. Look around you. If signal groups, stock tipping chats, and VIP rooms are still buzzing, then the market is still driven by speculation. When a true bottom forms, a strange silence takes over. No one talks about stocks anymore, groups go quiet, and money goes to sleep. The withdrawal of speculators is a clear sign that the market has flushed out short-term traders and is preparing for a healthier uptrend. Are you getting caught in the noise of chat room hype? If the pros are silent and only the loudest voices are shouting by, whose side are you really on? Now, you've noticed the clear signs that the market hasn't formed a true bottom yet. But is this a reason to give up? Definitely not. Understanding why the market isn't ready for a solid bottom yet is the first step in crafting a sound investment strategy. It's not always about buying the dip. Sometimes, waiting and observing will pay off more in the long run, especially in a volatile market. So how can you develop a safe and effective investment strategy right now? First, start by tracking and following the big money. True money flow into the market is not just a sign of stability, it's also a precise indicator of sustainable recovery. Foreign investment is probably the most critical signal. If large investment funds and international organizations continue to pour money into the market, it signals renewed confidence. ETFs, exchange-traded funds, are another important indicator. When ETFs start growing, it shows large investors believe in the market's underlying strength. Second, choose stocks with strong fundamentals and long-term potential. Stocks with steady growth, high profitability, and companies that can weather financial storms are better choices for long-term investors. Lastly, avoid investing all your funds at once. Instead, split your investments over several phases when clearer signals arise. This is a risk mitigation strategy and helps protect your capital in uncertain times. Have you been tracking the big money flow? Are major investment funds returning to the market? Do the stocks you're considering have strong fundamentals, or are they speculative? Can you break up your investment into smaller portions instead of diving in all at once? Now that you've learned the signs to avoid catching the fake bottom, are you ready for a solid investment strategy? Are you prepared to wait, research, and analyze the market carefully? Or will you continue acting on emotion and follow the crowd? Catching the bottom won't make you rich, but mastering emotions and staying disciplined will. Waiting doesn't mean missing out, it means preparing for a bigger, better leap forward. Final question. Pushpin, do you want to be the one who rushes into a crash or the one who calmly wins big in the next market cycle? If you found this video valuable, hit like to spread it to others who need it. And don't forget to subscribe to the Bold Steps Forward channel so you won't miss future financial strategies. Because success doesn't come from following the crowd, it comes from bold, thoughtful moves.